Robert Sinn, investor, trader, and author of Goldfinger Capital. Welcome to The Competent Investor. Thanks for joining me.
It's great to be on, Tom. It's a pleasure to be on The Competent Investor.
Robert, I'd like to start by getting, let's say, your broad state, your broad analysis of the mining sector right now with the sell-off. What do you see as the source of this downward pressure on the price of gold, silver? Is it basically rates and the dollar kind of re-exerting their historical correlation to the gold price?
Yeah, I mean, I would love to have some really fancy, complicated answer for you to make me sound super smart. But really, I think it's the dollar is just the simplest answer to this. If you look back to January, gold and silver peaked the last week of January. The dollar bottomed that week. And actually, it's funny. I like to look back at my Substack sometimes just to see what I was thinking at certain points in the past. And I wrote a blog post about the dollar at the end of January and sort of calling it out in sort of a bearish way, but also saying like this was a big test and let's see if the dollar can find support here. Well, it sure as heck did. It literally, within 2 days of that article, it bottomed, and now we're making new highs. And actually, the dollar index is one of the most bullish charts in the world right now. I actually tweeted that on Tuesday. So, and especially like the junior mining sector, very dollar sensitive, very cost of capital sensitive. So when the dollar strengthens, the CAD sells off like it. I mean, we're at like 142 and dollar, loonie. That's wild. That's a very weak, level for the Canadian dollar. And then yields pushing up, right? So when the 10-year gets above 4.5%, that's generally a negative. So it's kind of a perfect negative storm here for the mining sector, especially the junior mining sector. And yeah, that's hindsight, right? So I'm saying that now because that's what's just happened here in the last couple months. But the future might be a little bit, different. So we can talk about that.
Mm-hmm. Well, I want to contrast maybe, let's say, the conditions that were present for the metals in January versus what they are now. The only real explanation, or one of the explanations, let's say, that can come up with gold's performance in January was kind of this possible getting ahead of the conflict. This idea that gold anticipated the war. Is that something that you, I don't know if subscribe to is the right way to say it, but it does seem like gold has accounted for and gotten ahead of many of the moves in let's say the past 5 years here, 5 to 6 years.
Yeah, that's an astute point. I think that absolutely that's right. That was part of what was going on at the end of 2025 and in January, February 2026. I think definitely the cognoscenti, sort of the hedge fund elites knew something was coming, and they front ran it, as they often do, right? And then when it actually happened, and it started to drag out throughout March, and it was getting messy, it wasn't so clear. The strait was closed, blah blah blah. Oil spikes. Then all of a sudden, hold on, maybe gold is not the right trade here because yields are rising a lot. The dollar is strengthening. And some of these countries like India, like Turkey, suddenly they need to subsidize the price of gasoline and fuel for their population. and they're just getting squeezed, right? So they start to sell gold, right? And then, Modi, the Prime Minister of India, says, "Don't buy gold for a year," right? That's a big thing for the leader of India, the most populated country in the world that loves gold, to say, right? So it's kind of been a perfect negative storm for the last 3 months for gold and silver. And we're starting, this morning, I feel like we're getting very oversold. Sentiment is about as negative as I've seen it. Like, I'll never say it's the most, negative, but it's up there with like the March 2020, October 2022 kind of really negative, sentiment. And it feels bad suddenly to be a gold and silver investor.
Well, I think it was last week, or it was within the last 2 weeks, the gold miner bull index reached zero, right? So that, like, as a sentiment indicator, that was perfect. And I feel like it, I mean, theoretically it can't go below zero, but I feel like today we're speaking on June 24th. I feel like today should be even lower than that.
Well, you're referring to the BP, it's basically a measure of the number of gold stocks on buy signals or in uptrends, right? So that's a technical indicator, and it reached zero, basically. So zero breath, basically no gold miners at that, on that day a week or so ago. Actually, it was 2 weeks ago. Were in buy signals or in uptrends, right? Mm-hmm. So the breadth was just extremely negative. Sentiment's gotten even worse in the last 2 weeks, because since then we had a little rebound rally. We had a 3 to 4 day rebound, and that may have given some people hope. And now we've rolled over, and gold and silver have made lower lows. The gold miners, some of them are still above the low of 2 weeks ago, and some have broken down to new lows. But there's no doubt that the sentiment, investor sentiment, is reaching new lows, and that the daily sentiment index, which is something I think we've talked about before, and which I follow pretty closely, reached 13 for gold as of Tuesday, and we'll get another reading in about 5 hours. And that could very well reach 10 or maybe even into the single digits. And so, confluence of factors here, just including the fact that gold is really oversold and sentiment is so negative, and also seasonality. So as we get to Canada Day and the 4th, it's a big Independence Day, this year in the US, the 250th anniversary. Seasonality tends to improve over the next couple of weeks. So gold and silver tend to move up around this time of the year, and the miners tend to do pretty well over the next couple months. So that's something to look forward to here. Obviously, seasonality is far from a perfect indicator, and it might work 3 out of 5 times. It certainly doesn't work 5 out of 5 times. But when you're this oversold and people are this negative, and we've seen a liquidation over the last month, the odds start to favor maybe we're getting close to a tradable low here.
Mm-hmm. Well, it certainly seems like, taking Rick Rule's famous line of, when the sector goes on sale, you should like it even more. Certainly seems like there are buying opportunities if you had something on your shopping list. Of course, sentiment plays into that quite well. But, as a broader, taking this, the broader market into consideration, is this somewhat of a deflationary time because of oil coming down, the metals coming down, basically, many of the commodities that we've been looking at and anticipating this energy shock having an effect on, it completely reversing instead?
Yeah, that's another astute point. I feel like we are always looking in the rear view. That's just the way the world works. We have data from the past. We don't have data from the future. And markets and investors tend to freak out over what happened 2 months ago, right? Like we're getting data, we're getting CPI data from April. We'll get some more data from May tomorrow, but it's June 24th and tomorrow will be June 25th. So that's still very stale data. And so the data from March, April, and now in May is showing rising, core inflation, rising prices across many segments of the economy. But I don't think this is long-term, inflationary. This is a short-term burst that had to do with a very, unique event that the world has never seen before. I mean, this heavily trafficked strait in the middle of the biggest, countries that have oil, Saudi Arabia, Iran, et cetera. Suddenly, all that flow of oil is arrested for basically 3 months, and obviously some was sneaking through, but it was much less than the typical daily rates. That's a unique event. That's a once in a decade, once in a century, even maybe once in a once in history, event, right? And it's in theory, it's in the rear view mirror, right? And so, I think actually the bigger threat is deflation. It's actually deflation. And that, I know some of your viewers are going to say, this guy's an idiot, I'm turning this off. There's not deflation. The prices I pay for everything have been going up and they continue to go up. And I get it. It's true. But let's look to the future, not just the last year or the last 6 years. Let's actually, look to the future. And I think the bigger threat is deflation. And a couple of factors involved in that is technology, AI, robotics. Now, maybe that's still 3 or 4 years out, prior to, it might take 3 or 4 years for those technologies to really make a huge impact, but maybe it's happening sooner. And it's going to start to make itself felt throughout the economy. And suddenly you're going to have the ability to do all these things that previously were much harder to do and much more costly to do, whether it's getting a ride in a ride share or having a robot build your house for you, or write a contract for some sort of deal. Suddenly now you have AI that can do it, right? You might pay a lawyer $5,000 for that normally. You might still pay a lawyer just to have a human sign it, but the cost is going to be less because it's not going to take that lawyer as much time, right? So deflation is there, it's at the forefront. And actually, last week there was a tweet by Musk where he basically says the biggest threat is deflation because the amount of goods and services across the economy are going to expand massively over the next several years. And we're going to need to keep the prices from going down too much for all these goods and services and products. And so the government should actually send money directly to U.S. citizens, like helicopter money to stimulate more, consumption. That's a huge statement. So like when I saw that tweet from him, I said, wow, because everybody's been talking about inflation the first half of 2026. That's been the theme. And even, the Fed funds futures are worried about inflation and pricing in a potential rate hike in the second half of the year. And I think that's really hit gold hard because you think back to January, we were thinking there was a good chance of a rate cut in the second half of the year. So that's flipped on its head to now thinking of a rate hike. And my sense is the market's got it exactly wrong here. The Fed is not going to hike this year. They may not cut, but they're not going to hike. And then we'll get back to rate cuts potentially in 2027. And so that should be a tailwind for gold and silver.
Well, it's interesting to consider not only the deflationary, inflationary impulses that have presented themselves through this year, but also obviously the big change with Warsh coming in and saying specifically that he's going to be providing less forward guidance to the markets, which we've been used to through Powell's term here for like what would it be, the last 10 years basically. So do you think that has presented a lot of uncertainty to the markets when they were so used to having Powell come out and give this forward guidance?
Yeah, I think that's exactly right. So I think Warsh's strategy is to say less. Very clearly, he wants to keep the market, guessing a bit here in 2026. He's the new guy. He doesn't want to put all of his cards on the table. And there's a bit of uncertainty because you have all these interviews with him in the past, from 2015 and et cetera, where he's kind of talking hawkish, right? And he's saying we shouldn't do QE. We have to get the balance sheet smaller. We have to get inflation down. Yada yada yada. He's saying all these hawkish things. Then in his first press conference, he talks hawkish again, but doesn't really say much. He doesn't really give much away. But meanwhile, the guy who hired him has been pounding the table on rate cuts, and we should have interest rates at 1%. That's been Trump's bottom line since he got elected, right? So how do you mesh those two? The guy who hired him over many other candidates wants lower interest rates and wants a much easier monetary policy. And he's a housing guy, right? He's a builder. So he always wants low interest rates. But Warsh has generally taken a hawkish tilt during interviews and in his first press conference. So that's a really interesting quandary. And my take is that he wants to talk tough. He wants to be a verbal hawk, but the actions won't always match the words. I think they're standing pat. I don't think they're going to hike. I think that would be a mistake to hike, and he realizes it would be a mistake to hike here with what we have coming in terms of technology and such. And also, is he really going to hike in September when the midterms are 2 months after that? Is he gonna risk, a market upset or an economic upset? I really don't think so. Now, some people might say, well, if inflation is running too hot and they hike, the market might rally because they're addressing the problem. But I'm skeptical because I really don't think this inflation is permanent, right? I think I don't want to say transitory, but the price of oil is transitory, right? And we've seen that, right? And so maybe it is.
Mm-hmm. Well, going back to the dollar and rates here, it seems to me that coming out of this war, it doesn't seem like the U.S. gained anything by going in there. The U.S. spent a bunch of money and ended up lifting previous sanctions, giving Iran back seized assets, and kind of showing its hand in its ability to produce munitions to effectively insert itself into a conflict or to, let's say, impose its will on a conflict. So why is this time tending to be bullish for the dollar if this, by some accounts is a negative overall for the U.S.?
It's a great question. And I don't have a perfect answer to that. I think sometimes markets just tend to go places to inflict the maximum pain. And so my best answer is the dollar got really oversold in January Traders were very negative on the dollar, and everybody was just expecting that rate cuts were coming, and maybe even a Fed chair who would be more dovish.
Mm-hmm.
And there was a lot of uncertainty around like who was going to be the Fed chair. It might have been the other guy who was definitely more dovish. There was also uncertainty about what Trump might do with Powell. I mean, so like all these things factored into sort of a loss of confidence in the dollar in the second half of 2025, right? And then the dollar bottomed, and now it's rebounding, right? So it's a reversion to the long-term mean, in a sense, in the really long-term charts of the dollar index. But also, I think the dollar is just moving on interest rates, right? So the fact that we flipped from a cutting bias to a hiking bias, I think, is the main driver of the dollar. But yeah, I think it's a very good point you made about Iran, because the U.S. did not win this war clearly. Yes, the U.S. military dropped a lot of bombs. They damaged a lot of infrastructure, a lot of military hardware. I don't know how many people were killed, but I assume it's well into the thousands. And based upon reporting, what casualties did the U.S. take? I don't know. It was less than 20 killed, right? So if you look at those numbers, yeah, we won, but we're not able to dictate the terms of a deal. So we didn't really win, right? The fact that Iran is able to stand toe to toe in a room and say, we're not agreeing to this, we're not agreeing to that. We're gonna just go back to Tehran and make us another offer. That's not a victory, right? So the fact that Iran was able to stand toe to toe with the U.S. for a month and not wave the white flag, that's a big deal, right? That's a big deal. And why were they able to do that? Drone technology. I mean, that's the number one reason is drone technology. And look at Ukraine. They have actually turned the tables on Russia. And some would say they're winning now. Drone technology. And this is leveling the playing field, just like maybe artificial intelligence could level the playing field a bit too, right? So technology makes it so that the U.S. is no longer just this clear superpower, like such a large amount of separation, between number one and number two and number three, both in terms of the military capabilities, but also in terms of technology and possibly the economy, right? And so I think the dollar is natural. The dollar gradually loses more market share, and it's no longer the only currency game in town, right? And so, in a sense, I like to fade this rally, even though the chart is very bullish.
Mm-hmm. So, Robert, despite all of these, geopolitical shifts and everything, obviously investors still want to understand how to make money in this environment, right? So when I was reading that in March, you decided to kind of put aside all the news, all the Truth Social posts, any clarity of quote unquote negotiations in the war, and fall back to something that removed a lot of that noise. What was that, and why is it so important to you?
Well, yeah, just technical analysis, charts, right? Because price is truth, and there's a lot of mistruths in the world. There's a lot of propaganda. I mean, I feel like the war in Iran was a propaganda war. First and foremost, yeah, it was military. There were bombs, there were missiles, but it was a propaganda war, and it still is, right? So you can't
Mm-hmm. So that being said, Robert, are you looking to enter some positions that you've had your eye on, maybe some higher quality positions that ran a lot during, January to, or the very beginning of this year, and do you have an idea in mind of where some of these entry points might be.
Yeah, I mean, I think we're getting pretty close in a lot of names. So I would just tell the viewers, pull up 1 year charts of your favorite 10 miners, whether it's Newmont or Agnico Eagle or Barrick or Pan American Silver. Just pull up those charts and look to the left and look at the highs that were reached in Q4 2025. So the final quarter of 2025, prior to the silver frenzy in the final 2 weeks of the year and then into January. So, just look at like the October high. And if we're getting down to retest the October high in one or two of your favorite miners, well, maybe this is a time for you to actually look at buying these, or legging in 1/2 or 1/3 at a time, buy a little bit every week. But like we're basically there in a lot of these names, right? So we're retesting key support levels in a lot of these major miners, and so the risk is much less when a stock has already dropped 50% from its peak and it's at a major long-term key support level. The risk is much lower than it would otherwise be if you were buying it after it had already been in an uptrend and risen 50% in the last 2 months, right? So this is actually really a great time to be looking at the miners again, just because of how far they've fallen, how negative sentiment is, and the fact that we're back to these support levels from 2025.
Mm-hmm. Are you looking only at miners, or are you looking also in the oil sector?
I bought an oil services ETF this morning, the OIH. So yes, I am, and that's actually the first oil stock I bought since last year, right? So I was big into Chevron in Q4 of last year. That trade worked wonderfully. I sold it in January. Sold it a little early, but I sold it. And now I actually think finally, with oil back under 70, all the froth is out of it. I mean, it went to 120. Now it's back to 70. So all that I ran premium is gone, completely gone. It's incinerated. And now we're back at a real price level, a big support band between 65 and 70. So I actually like oil here. Mm-hmm. And I like, the oil services because they're also back to support. And they look a lot more attractive, both fundamentally and technically, So yes, I am looking at the oil sector again.
And again, to kind of be able to zoom back out and get this bigger picture, do you see this as anything fundamentally changing for something like oil, something like copper, silver, these metals that have what we see as production deficits going into a time when we're supposed to be having a higher demand to build all of this technological infrastructure?
Yeah, no, that's another really good point, because I think there's the physical world and there's the financial world, right? And so I believe what we're seeing in markets the last month is the financial world, right? It's a relief that supposedly we have a peace deal. We have a deal. The word deal is said 100 times a day. We have a deal and they're not shooting at each other anymore. So, let's breathe a sigh of, relief that we're not having a catastrophic crisis. Great. But now that's already come out of the market, right? The last month has taken all that out of the market. And now we can actually start to look at the physical world again. And what are the actual fundamentals for oil, for copper? What's the, reality of what happened in the Middle East in March and April? How much damage was done to the oil infrastructure there? How long will that take to come online? What's happening in Russia right now, right? Like, just look at some of those videos. You don't even have to read the news. You can look at these, refineries being bombed and burning up, right? So there's a lot of damage to key energy infrastructure around the globe. And so the market is basically saying, no problem, it's not an issue. And maybe even this price drop in oil is actually telling us a little bit about what's happening in the underlying economy, right? Like, maybe growth is actually not what it's been made out to be in the first half of 2026. And yeah, I mean, and then so turning to copper, copper went to almost $7 a pound, right? And now we're pulling back to 6, or maybe a little bit under 6. But this is still a very robust price. And the fundamentals for copper on the supply side are unchanged. They had nothing to do with Iran, really. They're unchanged. And the supply, constraints of large copper mines are still there. And actually, the output of some of the world's largest mines is actually declining year over year, right? And I don't know. I don't see a magic bullet to fix the copper, deficit. We're actually in a deficit here in 2026 because of a large mine in Indonesia and another mine in the Congo that are not performing to forecast, right? And so there's actually a deficit. And the data center thing, well, maybe it's overplayed a little bit. It's made out a lot like, oh, data centers. Right now, it's not that big of a marginal, mover in the copper market, but it's going to be a lot bigger impact over the next decade if those forecasts prove to be true. So maybe there was a little bit of front running there of what's coming from data centers that's in the copper price, but still, there's no magic bullet to bring on the supply that we need over the next decade.
Mm-hmm. So in these plays, Robert, when you're, looking at where to, let's say, provide opportunity for yourself in the mining sector, whether it is copper, whether it is silver, gold, whatever it is there anything in particular that you look at in these companies that must be there in order to consider it to be a buy?
That's a good question. That's a tough question, Tom. I mean, so I speculate in all three areas of the mining sector, right? So the seniors, I buy Newmont, I buy Barrick. The mid tiers, or the companies that have a resource and they're trying to get a permit, they're trying to get the money to build a mine, right? And then the juniors, the explorers, right? The really early stage ones, they don't even have a resource. They don't have an economic study, maybe, but they've got some good drill holes, right? So I speculate in all three areas of the mining life cycle. And, really in the seniors, I am mostly trading on the chart and the quarterly report. So the numbers the companies put out, like every 3 months, just is the free cash flow, going up? Are they containing costs, or are they letting costs get blown out? Right. So just like some of those key questions. But in the other two areas of the mining life cycle, I'm looking for catalysts. I'm looking for catalysts in the next 12 months. And, key catalysts for juniors could be getting a permit, getting a mining permit, getting financing to build the mine, right? So it reduces the risk of the project when you achieve those objectives, you achieve those milestones, and then there's a re-rating in the valuation. And then drill intercepts, right? Drill intercepts and positive economic studies, right? Like, these are things that actually move valuations and make a difference and can make a difference in terms of the returns that an investor is able to generate in the sector. So project has to be good, right? It has to be a quality asset, and the management team has to know what they're doing, right? And a lot of people say track record. Track record is very helpful, but even guys who have had a track record and have had some big wins still fail from time to time, right? So it's not a foolproof indicator, but really, I want to talk to the management team. I want to talk to the CEO. Like, I want to get an idea of their body language and their attitude and their level of excitement, and how much they have invested. Like, what's their skin in the game, and how much does it matter to them, right? So those are all very important things, but really, it's digging into the project level data. It's a little more technical, but with AI, we can cut through a lot of it pretty quickly. But you have to be careful with AI because it tends to want to always put a very optimistic flavor on everything. So you have to really push it with some of your prompts and your questions, and also just try to use your own brain. Like, don't forget about your own brain and actually going through the images, the graphics, trying to get a grasp on the ore body, where it can grow, where the grades are dropping off, like, is it cut off anywhere? So those are all important things. And, is it big enough to matter? I think this is a very important question you have to ask at all stages. Is it big enough to actually matter? Is it big enough, or can it grow large enough that it can warrant a premium valuation, at some point, in the future? And there's like a company today, Andina Copper put out another drill intercept from their porphyry project in Latin America. And this company is 9 for 9 in their drilling. So it's very early, 10 holes, it's 10 holes into the project, but every hole is hitting copper over really wide intervals, over 1,200 meter strike extent, right? So that's big. And so for me, that checks the box because they have a high hit rate, right? So that means the ore body is exceptional, that they don't miss, and they're not just drilling in the same place; they're drilling all over the place, 1,200 meters, and they keep hitting. And 1,200 meter strike down to 1,000 meters deep, 500 meters width. That tells me it's big enough. It's big enough to be a mine one day, right? And also, it doesn't have some of the fatal flaws that you might find in other projects. Like if there's 500 meters of dead rock that's sitting above the ore body, well, that might not work because it's too expensive. It's too costly to get through all that. But it starts at surface, and it's consistent, 0.5% copper. It's consistent. So for me, it's just like, that's a no-brainer, right? It checks the box. Like, that's a stock I want to own.
And obviously permitting is a big issue when it comes to a lot of those projects. Is that in a jurisdiction where it's actually likely to get permitted?
Colombia.
Okay. So I was reading a story about the other day about a copper project, and I think it's Arizona, that's been waiting 28 years for their permit.
Yeah. So it's Colombia, which has a mixed history in a lot of ways, and in terms of mining. But the good news about Colombia is we just finished having a leftist president the last 4 years. And even with a leftist president, they permitted a couple copper mines. It wasn't a lot. I think it was 2 over 4 years, but it's still possible. But the good news is a pro-business guy has just won the election. I think they have to do some challenge in the Supreme Court. So, it's not totally confirmed yet, but it's like 90%. And so obviously the country is moving further right and wants pro-business, right? And so the great thing about building a new mine is it brings in a lot of jobs to a region, and a lot of high-paying jobs, way above the average. It's normally way above the average for a region, because typically, you're not going to build a mine in San Francisco. You're going to build a mine in a rural area where there's usually not a lot of a lot of economic opportunities. So that's the case with Andina's project there. Not a lot of economic opportunities there in this region, and so I believe you can absolutely build a mine there, or else I wouldn't own the stock. That's not to say there won't be challenges. There's always going to be an objection. Doesn't matter where you are, if you're in Argentina, Canada, or Africa, Botswana, there's always going to be some people that don't agree, right? That's just the nature of the world, right? But if 90% do want it, well, then you've got a real shot, and I think that's the case. Yeah, and the one you're referring to in Arizona is the Resolution copper deposit, which is the largest copper resource in North America, and it's been dormant since they drilled it since they made the discovery in the early 2000s. They've done some infrastructure works. They've done a lot of work, in the community for sure, but the mine is not built because it has not received its final federal permits, and that is largely due to a Native American, objection, a local, Native American group that has objected to it. So that's been the sticking point. But it has widespread, support in Arizona and in this county in Arizona. So it's a minority of the population that's been blocking it, and I think it's going to be able to clear the final hurdles. But yeah, it's been a lengthy, costly process for Rio Tinto and BHP.
Mm-hmm. Yeah, and back to your point about AI, I read a funny tweet this morning. It said, "It's amazing how ChatGPT knows everything about subjects I know nothing about, but is wrong 40% of the time about things that I'm an expert on. Not going to think any further about this."
Yeah.
So just an idea to make sure you're double checking the information that you're taking in from AI, right?
For sure.
So, Robert, to kind of wrap up here, what big themes are you looking at or keeping an eye on for the rest of this year here?
Ooh, good one. I'm just going to stick to my knitting and what I know, and that's precious metals, base metals, copper, nickel, and miners, right? And so I think that we've had a bit of a correction here. It's actually now pretty stiff. It's pretty steep. There's a lot of pain out there. But I truly have confidence that the mining sector is in a secular bull market trend. And the reality is it can't always be going up, right? Mm-hmm. So if you pan out 10 years and you see a big uptrend over 10 years, well, all, interspersed in that decade-long bull run will be 2, 3, 4 month, retracements. And so that is exactly what we're having here in Q2 2026. And it serves to get people off of the trend. It serves to shake people out. And then the uptrend resumes, right? And so I think we're having a classic bull market shakeout, and it's scary and it's shaking people off. But I'm sticking to the trends that I know and that I understand, and I have really strong confidence and will continue. And that is precious metals and metals that are key and critical to the build out of the energy grid, to data centers and all the technology, including robotics, and the ones that are, major, that are majorly challenged in terms of the supply, like copper, right? And that theme is not changing. It's not changing anytime soon. So why get shaken out when lower prices just make it a better buy?
Well said, Robert. Of course, for those that are interested in more of your work, you write a ton of articles and really interesting stuff on Goldfinger Capital on Substack, and of course, your handles on X at Goldfinger, Goldfinger Capital on YouTube, and CEO Technician or
Yep.
Goldfinger on CEO.ca, right?
Yep, that's right.
Perfect. Robert, thanks so much for your time today.
Thank you, Tom. Appreciate it. It was a great conversation.